All right, welcome. Today we're putting on our detective hats. Our mission, should you choose to accept it, is to cut through all the noise of the stock market and figure out what a company is actually worth. We're going to hunt for the truth that's hidden deep inside the numbers. So, let's get started.
And that really brings us to the core mystery we're trying to solve here. Is that price you see flashing on the screen, is that the whole story? Or is there a deeper, truer value hiding underneath? Well, that's exactly what fundamental analysis helps us find out.
So, here's our game plan. First, we'll cover the core principles of our investigation. Then we'll analyze the playing field. After that, we'll decode the financials, the hard evidence. Then we'll assess the X factors, and finally, we'll reach our verdict.
Okay, so every good detective needs a code, a set of principles. And before we even peek at a single financial report, we have to understand the big ideas that are going to guide our search for a stock's real, true value.
This right here, this is the hidden treasure we're looking for. It's called intrinsic value. You can think of it like a company's financial DNA, what it's really worth based on its health and future, totally separate from the market's crazy mood swings. Our entire goal is to come up with a solid estimate for this number.
Now, it's super important to understand this distinction. We are not playing the role of market timers. We're not trying to read chart patterns to guess where the price will go tomorrow. No, we're business analysts, and we're focused on the long-term health of the business. So fundamental analysis tells you what company to buy. Technical analysis, that's a whole different ballgame. It tries to tell you when to buy. Our focus today is 100% on the what.
And that brings us to the golden rule of our investigation, and it comes straight from the master of value investing himself, Warren Buffett. Seriously, this one idea is the key to protecting yourself.
So what does this actually mean in practice? Well, once we do all the work and calculate that intrinsic value, we don't just run out and buy the stock at that price. Nope, we wait. We wait until we can buy it for a lot less. That gap between its true value and the price you pay, that is your margin of safety. It's your buffer, your financial bulletproof vest that protects you if you made a mistake or if things just go unexpectedly wrong.
All right, so we've got our guiding principles. Now it's time to start surveying the scene. See, a company doesn't just exist in a bubble. To really get what it's worth, you first have to understand the world it lives in, the broader economy and its specific industry.
Now, the standard procedure here is what's called the top-down EIC framework. It's simple, really. We start with the big picture, the economy. Then we narrow our focus down to the industry. And only then do we finally zoom in on the specific company. It just makes sure our final analysis is grounded in the real world.
Here's a perfect example of one of those big economic clues. When interest rates go up, it gets more expensive for companies to borrow money. This drives up their cost of capital. You can think of that like the minimum hurdle they have to clear to actually make a profit. And a higher hurdle means that all the money they expect to make in the future, well, it's worth less in today's dollars. And that directly lowers our estimate of the company's intrinsic value. See how it all connects?
Okay, so moving down to the industry level, we use tools like Porter's 5 Forces to size up the competition. We're asking, is this a nice, profitable industry where good companies can thrive? Or is it just a brutal dog-eat-dog world where profits get squeezed at every turn? This framework helps us figure that out.
Okay, we've surveyed the scene. Now it's time to get our hands dirty. We're diving into the hard evidence, the company's financial statements. This is where the numbers really start to tell a story.
Let's be honest, financial statements can feel like a sea of numbers. It can be totally overwhelming. So the real question is, where should we focus? Where are the clues that really matter?
Well, we start with key financial ratios. They act like a quick health check for the business. Return on equity, or ROE, tells you how good the managers are at using your money to make more money. Debt to equity shows you how risky the company is, and the PE ratio gives you a quick snapshot of what the market is thinking right now.
Now, this is an absolutely critical distinction. Net income, that's the official profit on the income statement, but it's got all sorts of accounting quirks in it. Free cash flow, on the other hand, that's the cold, hard cash that the business actually has left over. And at the end of the day, cash is king. Cash is what creates value.
And that leads us right here to the single most important piece of evidence in our entire investigation: unlevered free cash flow. This is the pure, raw cash the business generates from its main operations before it has to pay any lenders. It's the truest measure of a company's earning power, and it's the bedrock of our final valuation. You could say this is our smoking gun.
So the numbers are absolutely crucial, but believe it or not, they don't tell the whole story. Now we have to look for the X factors, those qualitative clues that tell us if a company's success can actually last.
A great company needs a great defense system. We call that its economic moat. It's some kind of durable advantage that protects it from competitors, just like a real moat used to protect a castle. It might be a super strong brand, a key patent, or maybe it's just a huge pain for customers to switch to a competitor. A wide moat is a fantastic sign of a truly tough business.
And of course, we have to look at the people running the show. I mean, you could have the greatest business in the world, but bad management can just drive it straight into the ground. We need to know if the leaders are making smart, long-term decisions with the company's cash. All right, we have gathered all of our clues. We've looked at the economy, the industry, the hard financial data, and all those qualitative X factors. Now it's time to put it all together, build our case, and finally, reach a verdict.
The main tool we use for this is called the Discounted Cash Flow Model, or DCF. Now, I know it sounds really complex, but it's basically just a 4-step recipe. First, we forecast those cash flows out into the future. Second, we figure out what those future dollars are worth today. Third, we estimate a long-term value for the business. And finally, we just add it all up. That sum gives us our final estimate of that all-important intrinsic value.
And the culmination of all this detective work is the investment thesis. Think of it like the final case file you present to a jury. It lays out all the evidence, it states your calculated intrinsic value, it explains all your reasoning, and it makes the final argument for why the company is or isn't a good investment at its current price.
So at the end of the day, remember that fundamental analysis isn't some magic crystal ball. It's a disciplined, investigative way of thinking, of understanding a business from the inside out. Now you have the framework to be the detective. So the only question left is, what story will the numbers tell you?